This is Macro Horizons, episode 370, April in Angst, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of April 20th. And as allergy season picks up and sniffles and tissues are commonplace, the only solace we find is that at least we no longer have to explain it's only allergies, not COVID. Remember the pandemic? Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, it was once again all about the war in the Middle East. Headlines related to the ceasefire drove a consolidation pattern in energy prices as the week came to an end. Translating this into price action in U.S. rates, we did see an extension of the period of consolidation. As a result, we are anticipating that the range trading thesis will continue to hold as long as the ceasefire remains in place. Eventually, the assumption is that there will be some type of peace deal, and then the question becomes, what's the new floor for energy prices, and how does that eventually flow through into the realized economic data? In terms of the data in the week just past, we actually saw disappointment on the inflation side. PPI, both headline and core, came in below expectations. In fact, core printed at just 0.1% for the month of March. Import prices also underperformed, increasing just 0.1%. This came in the wake of the elevated headline CPI, which was attributed largely to the spike in gasoline prices. So, putting this in the context of core PCE, we're assuming that we'll have a high 0.2 or a low 0.3. This would represent a modest improvement from the core PCE figures in January and February, although certainly not back to a pace that would get to the Fed's 2% inflation target. Taking a step back, when we think about the way in which the Treasury market has continued to consolidate, we've been focused on the compression of the Bollinger Bands, the upper and lower bands, which in the 30-year sector are just 10 basis points. For context, that's the lowest for this spread since early January. The dynamic is not dissimilar for 10-year yields, and all of this leaves us with the approach of continuing to expect that consolidation will be the norm. However, this is a coiling pattern, and as a result, we do expect that at some point there will be a trigger, whether that trigger comes in the form of headlines from Washington or the economic data itself, or even guidance from monetary policymakers. Eventually, the range will break. There's now certainly capacity on either side of the range for a bearish move or a bullish move to not necessarily recast the broader macro narrative, although we will be the first to concede there does seem to be a disconnect between low volatility in the rates market and high geopolitical uncertainty created by the war.
It wasn't an especially exciting week in the Treasury market, or frankly, any market, aside from equities, which saw the S&P 500 reclaim the 7,000 level, as risk markets continue to look past the war in Iran, and what this meant for broader financial markets has been evident in Treasuries via the narrowing range in 10-year yields that are seemingly increasingly well anchored to 425, where any rallies meaningfully through that level are subsequently retraced, as are any sell-offs, as the combination of decent enough inflation data, at least for now, with a labor market backdrop that continues to be healthy, and a broader economic outlook in the U.S. that is certainly uncertain, given the unknowns around the impact that the oil price shock will have, has all translated through to an assumption that the Fed is definitively in wait-and-see mode for the time being, even once Warsh presumably takes over next month, and that has left asset allocators in fixed income content to remain sidelined and reinforced a comfort with the current status quo. That has translated through to a MOVE index that is now effectively back to its pre-war levels, and the VIX that has retraced back to levels last seen in February. So, in a similar paradigm to what we saw before the initial attacks on Iran, volatility continues to grind lower, and that has translated to an increasingly well-entrenched trading range in treasuries, which won't persist indefinitely, but at least looking out into the April FOMC meeting, it probably will persist for now.
And in the context of a market that is coiling, it's worth noting that the Bollinger Bands around the 10-year yield, Bollinger Bands simply being plus or minus 2 standard deviations around the 20-day moving average, have narrowed remarkably over the course of the last week and a half. After peaking in the middle of March at roughly 55 basis points, the spread between the upper and lower band has narrowed to under 20 basis points. For context, in January, when the market was grinding sideways in a similar fashion, that spread got as narrow as 8.5 basis points. So there is still room to go before we can definitively say that volatility has left the building. But for the time being, I do think that trading the range has been the go-to strategy. Taking a step back, and at the risk of oversimplifying issues, 4.25 in 10-year yields seems close to fair value if you deconstruct Treasury yields into a combination of forward growth and inflation expectations with a modest amount of term premium. You have a 2% GDP target, you have a 2% inflation target, and you have 25 basis points in term premium. Of course, this is a gross oversimplification. Nonetheless, we're sympathetic to the idea that until there's greater clarity on the eventual fallout from the war in Iran into the real economy, both globally and in the U.S., that investors will remain reluctant to establish any significant positions. Now, on the topic of Warsh, we might be overly optimistic in assuming that the confirmation process goes smoothly. The rhetoric out of the White House suggests that Trump has no interest in making the DOJ probe go away, and given that Powell has already stated that he will retain his board seat until the DOJ probe has been fully concluded, the composition of the FOMC during the summer is another key wild card. All of that being said, we're confident that monetary policymakers at the Fed will rely on the economic data more than political influence when making policy decisions, as has been the case throughout the cycle.
And especially if Powell stays on the FOMC, even if not as chair, throughout the course of summer, given what we've heard from him after the latest round of data, that's likely another vote in the wait-and-see camp. While it's impossible to say, behind closed doors, what Powell might actually be thinking in terms of a political influence on his decision-making, in his time as chair, he has been consistent in relying on the data to explain his and the committee's rationale, while also emphasizing that the committee's forecasting tools, like the dot plot, are not a coordinated effort across the board and regional Fed presidents, but rather a collection of individual opinions. And so presumably what that will mean is that Powell's dot, whether he's chair or not, will continue to be a function of the realized labor market and inflation data, which for the time being hardly show any urgency for the Fed to resume the process of bringing rates lower. And so, as we get through the April FOMC, then get April's payrolls and CPI prints, which will be the absolute earliest we would see any impact of higher oil prices on hiring and realized inflation, the question then becomes, will 1 month's worth of data be enough to impact the decision-making for the June meeting? Probably not, and then as we approach more traditional summer trading conditions, it's not unrealistic to expect, barring some exogenous shock, private credit, AI, those both come to mind, but assuming we make it to Labor Day without a meaningful catalyst for an uptick in volatility, we're now talking about the September meeting as potentially the first opportunity that we will see the Fed bring rates lower. And if we've learned anything, if the data continues to show a resilient U.S. economy, and particularly a resilient U.S. labor market, there's not any reason we would expect the Fed would hesitate to delay the timing of the next cut to the fourth quarter. The reaction function remains the same, an easing bias that is intact, and a new Fed chair that wants to bring rates closer to 3%, but there's nothing to say that that process needs to play out in its entirety in 2026. It could start in 2026 and conclude in 2027, or even maybe be pushed into 2027 entirely.
And that presupposes the answer to another key debate at the moment, which is, will the Fed's next move be a rate cut or a rate hike? I think that that's a valid discussion to have, although clearly we're in the camp assuming that the Fed's most hawkish response function at the moment will be to simply delay rate cuts into later 2026 or early 2027. It's not that difficult to envision a scenario where equity prices continue to reach record high levels. That contributes to the wealth effect, which drives consumption for the upper quartile, and that chases prices higher as long as the labor market remains stable. In such an environment, if we get to the end of the year and inflation hasn't made more significant progress back towards the Fed's objective, then that would be a more reasonable time to talk about hiking and not cutting rates. But for the time being, we're viewing the pricing in the futures market as relatively fair. And for context, Fed funds futures don't have a full cut priced in until the second half of 2027.
And so from these levels, the market is more or less fair. What remains to be seen, and in terms of the next big potential catalysts, next week's retail sales print will offer some context on how the start of the move toward higher gas prices was impacting consumer spending, and obviously what that implies about the broader growth backdrop via consumption. And in this vein, one of the bigger conversations that was had early this year that has since fallen on the macro back burner has been the topic of Treasury issuance and how Besant's endeavors to more actively use the bill market to fund the deficit are being successful or not. We've now made it through tax season, and so looking ahead to the May refunding process, while we certainly don't think coupon auction sizes are going to be changing this soon, it's going to be telling to see how the revelations of tax season, combined with the price tag of the war in Iran, has impacted the Treasury Department's borrowing needs. Throughout all the uncertainty of 2026 so far, Besant's opinion that 10-year yields should be lower, and Warsh's agreement with that stance, reinforces the idea that greater cooperation between the Fed and Treasury Department are probably going to be a bullish tailwind for the longer end of the Treasury market. And so even if it's not impossible to see changes to auction sizes in August or November, we're erring towards the latter. As the tradability of the conflict in the Middle East continues to wane, we expect that the topic of issuance and how the Treasury and Fed are going to be more actively involved in the market will return to the forefront of the macro conversation. The April Fed meeting, the May refunding announcement are two easy calendar dates to point to that could potentially reignite this conversation.
And as we also recently learned, the U.S. government has started the process of refunding the $160 billion in tariffs that the Supreme Court ruled were not permissible. We certainly don't expect that to immediately translate into bill issuance. However, it does add to the deficit. Taking a quick step back, that dollar amount in terms of percentage of nominal GDP in 2025, however, is only 0.5%. So we're less concerned with the refund process being a true issuance story and instead view it as a modest stimulative tailwind for businesses.
And with gas prices where they are, we're going to need that tailwind. You can put a sale on a car, right?
I've seen a car for sale. In the week ahead, the primary focus will, once again, be on developments in the Middle East, any progress made toward a peace deal with Iran, and what that all could eventually mean for the energy complex and therefore forward inflation expectations. With little insight to add on that front, the only observation we'll make is that we would have, all else being equal, assumed that the market would have grown tired and a bit fatigued from trading headlines related to the Middle East, and to some extent that is true, but given the ceasefire and the potential for some type of deal, there's still a meaningful amount of headline risk associated with the conflict. On the data front, we have the March retail sales figures. Here the consensus is looking for an increase of 1.3%. Now, a lot of that is going to be driven by gasoline prices, and the market will be quick to look through to the control group series. This will provide investors with a glimpse into the degree to which higher energy costs are weighing on consumption elsewhere. So, while March's data will not be definitive in this regard, it should provide a little bit of context for the trade-offs being made on the consumer level. On the monetary policy front, Warsh's nomination hearing is scheduled for Tuesday morning. Now, there remains a great deal of uncertainty as it relates to whether or not Powell will leave when his term expires, and even whether or not Tillis is going to follow through with his vow to block Warsh's confirmation until there's resolution of the DOJ probe. In terms of questions and concerns that the committee might have, a focus on central banking independence, a focus on the labor market. We expect the emphasis will be on all the fundamentals associated with being the chair of the FOMC. In terms of supply, We have 13 billion 20 years on Wednesday afternoon, followed by 26 billion 5-year tips on Thursday. Said differently, it's not going to be a particularly active week on the supply front. Even as such, recent auctions have gone reasonably well, all things considered. The market has long since left behind worries about a wholesale buyer's strike in U.S. Treasuries that results in higher rates and or greater auction concessions. Even as such, the liquidity events remain relevant, and as we look forward toward the end of April, what we see is that we have the FOMC meeting on Wednesday, April 29th, immediately followed by month end. So taking this in totality, we do anticipate that over the week ahead, any material backup in yields that challenges the upper bound of the range will be a buying opportunity as investors look forward to month end and the fact that the range consolidation appears to be the path of least resistance. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And with temperatures on the rise alongside gasoline prices, summer road trips are beginning to look more like a luxury good than a rite of passage. But given the recent spike in energy costs, the same could be said about air conditioning. It's going to be a long summer. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.